The Origins of Money and the Development of the Modern Financial System by L. Randall Wray. The Orthodox Story. According to the Orthodox Story, barter replaced self-sufficiency and increased efficiency by allowing for specialization. Footnote 1. The Orthodox story presented here can be found in the typical principles and money and banking texts. See, for example, Samuelson, 1973. Orthodox economic historians add much detail to the story. See Schweikart, 1991, for a detailed historiographical survey of money and banking in the U.S. While these economic historians would reject the simple Orthodox story presented here, their historical analyses do reflect a similar theoretical position regarding the nature of money. End footnote. It was then discovered that further efficiency could be gained by using some object as a medium of exchange to eliminate the necessity of a happy coincidence of wants required for barter to take place. Thus, money springs forth to facilitate exchange by lubricating the market mechanism, which had previously relied upon barter. Money is created to minimize transaction costs. Further, fair ground barter replaced isolated barter because this lowered the cost per unit of time taken to complete a transaction. Thus, the development of money and markets allowed the economy to move toward its optimum position represented by the lowest transactions costs. The argument is extended to the development of fiat money by noting that in the 17th century, commodity money was commonly deposited with goldsmiths for safekeeping against receipts called goldsmiths' notes. Time and effort, now called shoe leather costs, could be saved by exchanging notes rather than by reclaiming the gold each time an exchange was made. Goldsmiths discovered that, as a result, some notes were permanently in circulation so that the gold they represented was never withdrawn. Thus, they could safely lend these gold reserves or issue additional receipts as loans, creating the equivalent of modern fractional reserve banking. Since the costs of writing out the receipts were less than mining gold, goldsmith banking was also a rational economic decision taken by the economy to reduce the costs of the transactions structure. Paper money thus replaced commodity money. However, as goldsmiths had to keep some commodity money to facilitate clearing with other goldsmiths, and for deposit withdrawals, the quantity of paper money issued would be closely governed by the quantity of commodity money held in reserve. Some of the goldsmiths gradually specialized, and the modern private banking system emerged, based on fractional reserve deposit banking. Footnote 2. The transition from a system based on paper money, banknotes, to one based on deposits does not play a prominent role in Orthodox thought. It may be explained as a consequence of taxes placed on notes. Thus, deposits carried lower transactions costs. End footnote. Somehow, governments began to compete by issuing fiat money either through their treasuries or through their central banks. Private banks were permitted or required to hold this governmental or quasi-governmental fiat money as reserves. Thus, an increase in the issue of government fiat money would lead to a multiple expansion of bank deposits in the fractional reserve system. While the deposit multiplier might vary, central bank control over the privately issued supply of paper money and later demand deposits is ensured through control of bank reserves. In order to prevent excessive money from being privately created, the central bank must closely regulate the quantity of reserves. Lack of moral fiber on the part of the authorities leads to excess reserves and to excessive money. When the public finds itself with too much money, it spends the excess, causing inflation. Thus, the primary responsibility of the central bank is to serve as an inflation guard dog. Footnote 3. Or it is to serve as a lapdog for rentier interests. C. May and Grant, 1991.